Hello, everybody, and welcome. As we like to do every week, we like to take a look at the past week's market activity and then kind of bounce around the market and look for something to trade. And if you've been watching the market at all in the last week, you've seen essentially this happen, which is a huge down move over the past week. I think it's like a 5% down move or something like that over the course of the week. So, what happens when we get down moves in the market? Well, that generally means volatility increases. And if you've taken any of my courses or trade the way I do, we're volatility-based traders. And today I'm going to show you why we are and what the benefit is for being a volatility-based trader. So what we're going to do is first we're going to start by going into all the different ETFs and the indices. We're going to look for the most volatile one, and then I'll show you why why the research has showed over time that volatility is a great trading tool. So if we go to the S&P 500, which is just what I just showed you was the future, the S&P future, this is just the ETF. And we're going to go down here and look at the volatility right now. And you see right now, the volatility in SPY is 29. We will go over to the NASDAQ and look down here again and see this one is 33. And then we'll go to the Russell, which is IWM, and you see this one is the highest at 35. So, as far as the highest volatility, we're going to go to IWM to make our trade. So let me show you how volatility plays into actual reality, like what it means, because I can talk about volatility all day long, but you kind of need to see it to really understand it. So what we're going to do is we're going to zoom in here into the last couple weeks. And what I'm going to do is I'm going to go back just about 2 weeks. Right here, if you look up here at the date, right here the date will change as I move over the different areas, and you see this is January 20th. If you look at January 20th, you see the volatility. This is the volatility line. You see it's way down here at around 23 or something like that. And in the past week and a half, as this has shot down, you see volatility has shot way up here to 35. Again, what does that mean? Why do we want to trade volatility? Why is it such a useful tool for us? So what I'm going to do now is I'm going to go back in time to the 20th, and we're going to compare that trade to making as close to the same trade today so we can compare apples to apples. So if I go back in time, and here what I've done is I've gone back to January 20th. This software allows me to go back in time and look at past dates and things like that, what the prices were. And what we're going to look at here is the price, and let's just keep it easy. Let's just say the price is 214. So when I went to, let's say, make this trade on January 20th, back when volatility was fairly low, I could make this trade by selling the 232.5, which is roughly, what's that, about $18 away, and as close as I could get with the strikes we had available just down here at 197. Again, roughly $18. I'm stretching it a bit, but it's about the same distance, about $18 away. In this case, it was a $2.5 wide iron condor. Not important for this example, just because that's the strikes that were available. What's important here is this. At this time, we were collecting 68 cents credit for this trade. So again, I need you to remember these numbers. 214 is where we started. We went roughly $18 away on the call and put side, created this iron condor, and we're collecting about 68 cents when we did that. So now let's compare that to today and making roughly the same trade. So if I go to a trade page, and this is today, up here you see it's 205.50 roughly. So what am I doing here? Again, let's just make it simple. Let's just say it's 205. And I'm using the same, as close as I could to the same expiration cycle. The other one I didn't point out was 37 days. This is 40. So again, roughly the same distance as far as time. So time we take out of this example. That's not affecting anything because time is about the same. The only difference now is volatility. How does it affect the trade? So here you can see what I'll do is I'll go up $20. Remember, the other one was 18, and I'll go down $20. The other one was 18, and I'm collecting roughly the same amount of money. Market is closed right now, so this bid-ask spread is wide. But if we go right to the mid price between 50 and 90, it's 70. So what happened? Well, because of the volatility, now remember I was $18 away before. Now I'm a full $20 away. So I've gone $2 farther away, and I've collected the same amount of credit. And you might say, well, that's because it's more volatile. Of course, with more volatility, things are going to widen out. And that's what volatility means. As things get more volatile, I can get further away from the stock price and collect the same amount of money. That's the apples to apples comparison. And the reason this is important as volatility-based traders is research. Again, this isn't my belief. This has been proven with research. Volatility is generally overstated. So what that means is when things are volatile and people get freaked out, they usually freak out more than they are required to freak out, right? I mean, something happens and people kind of freak out. But in the end, when we look at what happened in reality, it probably wasn't as bad as we thought. That's what volatility tells us in the market. So when volatility shoots up in this last few days, and now we can go out $20 away instead of 18, the reason that's important is because we're hoping that in the end, really, it's not going to be as volatile as we think, and probably hopefully, the stock will only move, let's say, $10 instead of the expected 20 to get us that cushion. We have more of a cushion, and over time, most of the time, volatility is overstated. Not always, of course, but that's the game we play, is that we're betting when volatility shoots up, people have overstated the volatility. They've gotten too scared when it's not as frightening as it appears. And by going out $20 here instead of 18, that extra cushion now, maybe the stock only moves $10 or $12, not the expected 20, and that's how we collect our money. So that is the apples to apples comparison as to why volatility is so important when we trade. If it's there, we take advantage of it. In this case, markets dropped, volatility shot up, so we're going to go out and sell this iron condor tomorrow in the 40-day cycle. Now normally I'd go right here at 47 and it'd be 46 tomorrow, which is perfect, but I wanted to compare apples to apples, so I don't want to set this whole thing up all over again. But essentially that's what we're doing. We're going to go out and look to collect, in this case, around 70 cents. This is a $2.50 wide iron condor, so we're looking to collect hopefully around 75 if we could. All going to depend on the strikes, but really I just wanted to do this as an example of comparing volatility to lower volatility. The trade tomorrow you can play with and pick whatever strikes you want. Again, we're always looking for 33 to 50 cents per dollar width. So if tomorrow you can make this a $2 wide iron condor, we'd like to collect at least 66 cents. If it's $2.50 wide, we're looking to collect around 75 cents, and we'll move the sides in until we get to that number. Hopefully that is not too complicated. You might need to watch this a couple of times. But again, that's the overall explanation as to why volatility is so important to us as traders, because generally speaking, it allows us to go out further away, move our strikes further away, and collect the same or more credit. That's kind of the basis for all the trading we do. So that's our trade for tomorrow. Hopefully you enjoyed this.